For 5,000 years, the geologic ratio has been 16 to 1. And you go back through history, you'll see that even Isaac Newton made the currency in the mint in Great Britain 16 to 1, 16 silver to 1 gold. That had been the geological ratio forever. Now, man's ratio since the Industrial Revolution has been on average, about 45 to 1. And that was because gold was money and silver was industrial. The manipulation of the silver market, largely, I believe, by the Western military industrial complex to make high-tech weapons, has really skewed things, even though the geologic ratio has been 16 to 1 for 5,000 years. It is now 7 to 1. It's depleting in nature.
The precious metals market is entering a phase where long-standing assumptions are being quietly but decisively challenged. For decades, investors have treated gold as monetary insurance and silver as a volatile industrial adjunct, oscillating between neglect and speculative enthusiasm. Yet beneath the surface, structural forces are building that are no longer cyclical or sentiment-driven. Supply constraints, delivery stress, and a reassessment of historical valuation metrics are converging in a way that demands close attention, particularly for those who understand that relative value often matters more than headline prices. One of the most important signals in this environment is the gold-silver ratio, a metric that has repeatedly marked turning points in precious metals cycles across centuries. Historically, that ratio has not merely reflected investor preference, but the physical realities of geology, mining economics, and monetary use. Today, the ratio remains historically elevated, but the forces supporting that imbalance are weakening. According to Andy Schectman, the market is approaching a point where the ratio no longer reflects either natural supply or emerging demand, setting the stage for a rapid compression toward levels near 45 to 1 or potentially even lower. Andy Schectman's analysis is especially compelling because it extends beyond price charts and into the physical structure of the silver market itself. He argues that silver's geological ratio, the amount of silver available in nature relative to gold, is no longer static and is, in fact, declining rapidly. Large, easily accessible silver deposits have already been exhausted, while new supply increasingly comes as a byproduct of base metal mining rather than from primary silver producers. This erosion in natural availability is occurring at the same time that industrial demand, particularly from advanced technologies, continues to expand. Equally significant is Andy's observation that institutional behavior in the silver market is changing in ways rarely seen before. When a financial institution as large and systemically important as J.P. Morgan shifts from maintaining substantial short exposure to accumulating physical silver and long positions, it signals more than tactical repositioning. It suggests a reassessment of risk at the highest levels of the market. Andy frames this not as speculation, but as evidence that some of the most informed participants are preparing for conditions where physical silver becomes increasingly difficult to source at suppressed prices. In this discussion, Andy also connects these developments to broader economic pressures in the United States, mounting stresses in paper markets, and a delivery system that appears far less resilient than most investors assume. Stay with us as we break down how these forces intersect, why the gold-silver ratio sits at the center of this shift, and what it could mean for capital positioning in the years ahead. If you find value in this kind of deep, analytical breakdown, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss future updates. Thank you and enjoy the video.
Well, I mean, shorting, this type of naked shorting happens all the time. A lot of times it happens in very thinly traded markets where they'll dump it in the access market overnight and they'll dump paper contracts. You see, what's different now is that no one ever stood for delivery on these exchanges, and so they could paper manipulate it by selling paper contracts at a level that would overwhelm the longs. And they would continue to sell and drive down the paper price until the longs would capitulate and sell. And they would then be able to cover those positions very easily. The banks would, who had shorted the price, would be able to cover their positions very easily as they had driven down the paper price. Where it gets difficult for them is in now the fact that the people on the other side of the trade have become very wise to what they're doing, and they're standing for delivery. And it doesn't matter how far you push the paper price down when you have people standing for delivery. Said another way, in a market that is based upon trust, right? It works until you have people stand for delivery. Most of my career, which is now almost 36 years, no one ever stood for delivery. When I tell you less than 1% of contracts stood for delivery, I'm dead serious. No one stood for delivery. And now they are. And there's a good portion of the market that is challenging the West. These are countries, sovereign wealth funds, and central banks of India and Saudi Arabia and Russia and China, and on, that are now standing for delivery. These countries never had any intention to stand for delivery or challenge the West. They're coordinated now, they're motivated, and they smell blood in the water. But what is interesting is you're now seeing the exact same thing happen here in the United States. And it's interesting because there was a report in the Economic Times, Jay, that said, I just read it a couple days ago, that said JP Morgan now holds over 750 million ounces of silver. That's more than $40 billion worth, and would be, if true, the largest stockpile on the planet. It goes on to say that they have not only stopped shorting the market as of recently, but they have completely flipped and become the biggest long in the market. And it said that in 6 weeks, they added 21 million ounces while closing a 200 million ounce short position. This is the 200 million ounces was the pressure that kept the price low. When you have traders come in odd hours and dump more onto the market, it just suppresses it that much faster and triggers stops. A lot of these longs will be run by algorithms or hedge funds that run by algorithms. And if a level is breached, it sells. And so they will come in the access market, as we saw a few weeks ago, which is when New York is closed and before it gets to Asia, or in between either Asia and London or US and Asia. It doesn't matter. They are selling it at the most inopportune time, when there is no liquidity in the market, when the traders are asleep, when anyone who was stupid enough to do that would be shot and fired, and probably in that order, in the respect that that's not how you maximize your settlement, your trade. You would do it in the middle of New York trading when the traders are active, and you do it slowly over time. So going back to JP Morgan, they closed out a 200 million ounce paper short, which again is the pressure that is keeping it down. And they added 21 million ounces in physical over that time. The buying pushes prices up. The article went on to say that they also added 16.6 or took 16.6 million ounces out of their registered inventory. In COMEX, there's eligible, there's registered. Eligible, we have 9 COMEX vaults around North America. One is Brinks JFK in New York. That is a COMEX vault. If you have 1,000-ounce bars in our program, as many do, those are eligible. They could be sold. They could be moved into registered. They are eligible to be moved into registered, but they're not. They belong in strong hands, and they're not for sale. Registered are actually the bars that back the contracts. So JP Morgan pulled 16.6 million ounces out of registered inventory, and it left the COMEX. Now that's goodbye. That's never coming back. Once it leaves, it has to be reintroduced into the system, re-registered and assayed. It's never coming back. That would, in my mind, be someone like a Tesla or a Samsung or a Sony. And of course, that same channel talks about Samsung in an effort to get silver for their solid state batteries flying to Mexico, that same AI channel. And that may be true. Again, there is truth in some of what they're saying. But again, you're seeing big players because, look, China, as I've been reporting, has been going to Mexico and to Peru for the last several years, buying doré and concentrate right from the miners in pre-production stage before it's even called silver. Buying it and bringing it back home. What's interesting is Mexico's number 1, China's number 2, and Peru's number 3. So the number 2 producer in the world goes to number 1 and 3, buys doré and concentrate before it's ever even becomes silver. Concentrate is a byproduct sludge of the mining process, and doré are crudely refined bars. Well, they think it's important enough to fly all the way to Central America or South America, buy it, in unrefined form, pay double what the West will, ship it back to China to refine it. This is the second largest producer in the world. So going back to what I was saying, they pulled 16.6 million ounces out of registered and off it goes. It's never coming back. They also did something that I wasn't really familiar with, and it's called they moved 169 million ounces into non-deliverable vaults. To me, that's the same thing as pulling it out of the system. But that means the metal still exists on paper, but they legally removed it from the delivery system. Can't be used for COMEX unless it's re-registered. What you are seeing JP Morgan do is effectively um, removing metal from the delivery pool to get as far away from it as they can. And if it's true, and they are now net long, and the largest short position is now the largest long in the marketplace, this is a very, very, very bullish signal.
Building from Andy's explanation of market mechanics, the silver market's vulnerability becomes clearer when viewed through the lens of paper leverage and delivery behavior. For most of modern financial history, futures markets functioned on the assumption that contracts would rarely result in physical settlement. This allowed large volumes of paper silver to be sold and repurchased with minimal friction, often overwhelming real demand and suppressing price discovery. According to Andy, that dynamic has changed materially, as a growing number of participants now insist on taking delivery rather than rolling or cash settling their positions. This shift directly undermines the effectiveness of traditional price suppression strategies. When buyers stand for delivery, selling additional paper contracts no longer resolves short exposure. It magnifies it. Andy ties this directly to the behavior of sovereign entities, central banks, and large industrial consumers who are no longer content to rely on trust-based settlement systems. As delivery volumes increase and available registered inventories decline, the gold-silver ratio begins to reflect physical scarcity rather than financial engineering, reinforcing the case for a sustained move toward historically lower ratio levels.
A couple other things. I talk about how no one ever stood for delivery, right? In the first 12 days of the December delivery, which started the day after Thanksgiving, and you wonder why the server shut down Thanksgiving night, of the 1,000 commodities traded, just happened to shut down on the metals market. The servers overheated because there was obviously a bevy of activity on Thanksgiving night, and the traders left dinner to go lock in orders. No, it was damage control. But in the first 12 days of delivery that we've seen, now I haven't looked in the last 2 days, we saw 58 million ounces of silver delivered and 2.85 million ounces of gold, with contracts still being issued all month long that can stand for delivery. But ask yourself, who's got the money to stand for delivery on 58 million ounces? But this is what we've seen every single month for the past 13 months since he won the election. Literally, this is what we've seen on every single month. 2.84 million in gold and 58 million ounces in silver just in 12 days. And of the 12 days, 4 or 5 of them were weekends. So, you're talking 6 or 7, 8 trading days, and you're seeing this kind of volume. Things are beginning to get very, very, very interesting in the market again. You got rising lease rates in London and in the U.S., all of that stuff. I don't know, man. It's things are beginning to get very interesting in the silver market, and it is because of physical delivery. It is the delivery that is overwhelming the system, and that is what is changing the narrative.
So
100%. And at that level, when you see this kind of volume coming in, these people are the most well-informed traders on the planet, not just the most well-funded. And at that level, you're tied into the playbook, and they know what's coming, and they don't spend billions every month, literally billions every month for 13 months unless they have been told this is how you should probably position yourself. At that level, when you're dealing in billions, you're probably tied into the people that make the decisions and know the playbook. And so they don't do things just for shits and giggles. They do it because they know, to your point, what's coming.
Okay, we've seen the GSR. I think it was around 80. It dipped back down to 70, and then we saw it go up to about 106 or so. And now we've seen it slowly come down to 90 and then slowly down to 80. Once we hit 80, we started seeing it drop very quickly down into the 60s.
Yeah, 70 is way too. 70 is still abnormally high historically. It's at just about 67, 68 right now. The average of the past 100 plus years since the Industrial Revolution, man's ratio has been about 45 to 1, right in that neighborhood. For most of the people who have bought 45 to 1 would represent at least a double, because it's been abnormally skewed for the past several years. Going back to 2020, it hit 125 to 1, the all-time high. I remember the first video I did was with Bix Weir in 2010, and we were talking about how it had hit 85 to 1. It was like the second time in human history it had ever been that high. So I went on that show with him and told people, if you own gold, sell it. I'll sell it to the marketplace at an 85 to 1 ratio to silver. You can turn around and get roughly 85 ounces of silver. Now it would depend upon what kind of gold and what kind of silver, but in general, 85 to 1. So you get 85 ounces for every ounce of silver. Now remember, for 5,000, for every ounce of gold, for 5,000 years, the geologic ratio has been 16 to 1. And you go back through history, you'll see that even Isaac Newton made the currency in the mint in Great Britain 16 to 1, 16 silver to 1 gold. That had been the geological ratio forever. Now, man's ratio since the Industrial Revolution has been on average, about 45 to 1. And that was because gold was money and silver was industrial. The manipulation of the silver market, largely, I believe, by the Western military industrial complex to make high-tech weapons, has really skewed things. And when you mess with Mother Nature, she gets her vengeance, and she will. Going back to that video I did with Bix, now remember, the average has been about 42 to 45 to 1, even though the geologic ratio has been 16 to 1 for 5,000 years. It is now 7 to 1. It's depleting in nature. It's found in nature in a form called epithermal, like your skin is epidermis, very near the surface. Big deposits were found forever ago. Of the 800 plus million ounces mined last year, only about 20% came from companies that actually mine silver. The rest were byproduct companies mining copper, zinc, lead, that kind of stuff. But when Bix and I did that, I told everyone to do it. They would have got 85 ounces of silver in essence for 1 ounce of gold. Within 7 months, mid 2011, you had the then previous peak of 1915 gold to the $50 silver. It's 37 to 1. It got even a little lower in that, but you would have only needed 37 ounces of silver to trade back into 1 ounce of gold, making over twice what you started with. That is just reaching pretty much the 200-year average. At 42 to 1, you're still 6 times higher than it's coming out of the ground at. Keith Neumeyer will tell you it's 7 to 1 right now, that it is depleting, absolutely. And I believe it. And so when you talk about the trade of a generation, look, if all of you people who have bought in the 80s, as most people have who've bought in the last 5 years or higher, if all that were to happen was it were to reach its 200-year average, 150-year average, it's a double when you switch back into gold. And that would still be 6 times higher than it's coming out of the ground at. So in theory, yeah, I mean, a double is just reaching the average of the last 100 plus years. To expect it to go into a much lower range, 30s, 20s, I mean, it's realistic, it's possible. Don't know how fast it happens, or, no one knows the future, but simply to say at 20 to 1, look, in biblical times, it was 1 to 1 value. But with the geological ratio, or the geological footprint of silver depleting the way that it is, and the demand accentuating the way that it is, at some point the mining ratio has to come into play. So yeah, I would definitely say 70 to 1 is way too high to be doing this. And 40 to 1 ish, it's a double for most people. That's when I would start doing it, when it hits the 40s, and there's a high probability that it will.
The longer-term implications of this shift extend well beyond short-term price movements. If the gold-silver ratio compresses toward its post-industrial average near 45 to 1, silver would not need speculative excess to outperform. It would merely need normalization. Andy emphasizes that even such a move would still leave silver priced far above its current geological extraction ratio, underscoring how distorted the market remains despite recent gains. This reframes silver not as a high-risk bet, but as an asset still priced below its structural equilibrium. Another critical dimension is the role of physical withdrawal from the market. Andy highlights that acquiring silver is no longer just about going long contracts, but about removing metal from circulation altogether. When physical silver is transferred out of registered inventories or placed into non-deliverable vaults, it ceases to function as collateral for paper claims. Over time, this process tightens supply regardless of price, particularly when industrial users compete with investors for the same finite pool of metal. These pressures are compounded by the nature of modern silver production. With the majority of silver now mined as a byproduct, higher prices alone do not guarantee a rapid increase in supply. Copper, zinc, and lead producers will not materially expand output simply because silver prices rise, meaning demand shocks translate more directly into price volatility. Andy argues that this structural rigidity makes silver uniquely sensitive to sustained investment flows, especially in an environment where trust in paper markets continues to erode. The gold-silver ratio, then, becomes more than a trading signal. It becomes a diagnostic tool for systemic stress. Historically, sharp declines in the ratio have coincided with moments when confidence in financial intermediaries weakened and tangible assets reasserted their role as monetary anchors. Andy's view is that current conditions resemble those inflection points, not because of panic, but because of calculated repositioning by institutions that understand the constraints of the system. As these forces continue to develop, investors are faced with a choice between reacting to price headlines or studying the mechanics beneath them. Andy Schectman's analysis suggests that silver's recent highs may not represent an endpoint, but an early stage in a broader revaluation driven by geology, delivery realities, and institutional behavior. Understanding those drivers is essential for anyone seeking to navigate the next phase of the precious metals cycle with clarity rather than emotion. If you found this breakdown useful, consider sharing the video with others who follow the precious metals space and appreciate evidence-based analysis. Subscribe to the channel for more in-depth discussions like this, and thank you for watching.